Thanks very much, Andila. It's a privilege to be hosting a panel discussion entitled, How Do You Define Good Advice? In this discussion, the hope is that to some extent, our expert panelists will be able to unpack issues around advice in relation to the retirement market, looking at the significance of unbiased advice, trends in employee benefits advice, advice around the new two-pot retirement fund system, as well as the impact of advisor fee payment models on the quality of advice that pension fund members will get, among other issues. Well, let me introduce our panelists. I'm joined in our studio by Anthony Govendor. He's from ASI. Lorraine Dias, she's from Mercer Marsh Benefits, and Lynn Kimball of the Silvertree Group. And without any further ado, we're going to get straight into it and start by looking at the area of unbiased advice and why it's so critically important. Lorraine, thank you very much for joining us. I'd like to get your view on what is the significance of unbiased advice in the retirement market.
For me, the significance is that the advice that's given really needs to be in the best interest of members. And if there are any conflicts of interests, that can lead to members perhaps not being given the best advice or perhaps being overcharged when it comes to fees. I think that unbiased advice is critical because members need to be given the best option, and there's often multiple options available. But if the advice is biased, they could be referred to as a particular service provider without alternative service providers or product offerings being considered. And this may actually not be in the best interest of members. And this can result in them not having optimal retirement fund outcomes.
Yes. Mm-hmm. Well, as we start our conversation, it's ladies first. So I'm going to pop over to Lynn. Lynn, what's the best way that advisors can try and avoid conflict of interest when they're rendering retirement advice?
I think independent advice is crucial, not to have an allegiance to any one provider. And unbiased advice cultivates trust and confidence. So our industry is very much focused on relationship building. And I think when you have a member's first priority, you're always going to be able to cultivate that trust and confidence over time.
So, Anthony, what is the distinction between unbiased advice or independent advice as opposed to tied advice? And if you can just give practical examples as to why you think one is better than the other.
So, Nampu, maybe just coming back to what Lorraine and Lynn was saying earlier, that ultimately as advisors, we serve the best interest of the member. And I think the fundamental currency that an advisor and a client trades by is trust. If the client trusts the advisor, ultimately you would accept advice. Now, being an independent advisor, it's really about protecting the best interest of the client. And how do you protect the best interest of the client? It's about operating with integrity and making sure that the advice that you are providing to the client ultimately best serves the legacy needs of that particular client. And an independent advisor offers the client the option of a range of options. He's not linked to one product house or one administrator or one insurer. And being an independent advisor, it's ultimately about providing advice in the best interest of the client and not necessarily the insurer, the product house you represent. A tied agent, of course, is compelled to sell the product of the house that he's employed by. And that presents an inherent conflict of interest. If you were the customer, typically, if you had to ask me as an independent financial advisor to go out to the market and look at various options available to you, as an independent advisor, I would look at a multiple of insurers or investment houses and come back to you and present you with a range of options based on price and value, and ultimately looking at a needs analysis on what best serves you and your family. A tied agent would probably go through the same exercise of going through a needs analysis. However, is constrained just to the products of that one administrator or insurance house. And that presents a inherent conflict of interest and ultimately does not serve the client well based on the integrity of their needs and the advice that's going to be given.
Can't the two coexist?
Can the two industries coexist? I don't believe they can. For as long as the industry talks about treating the customer fairly, For as long as the industry talks about serving the best interest of the client and offering advice with integrity, I don't believe a tied agency model and an independent advisor model could work. The reality is tied agency models are driven by production, perverse incentives where brokers earn exorbitant commissions, and a lot of these commissions are not necessarily disclosed to the customer. If I circle back to what Lynn was saying earlier, and that is, how do you best serve the client? There has to be disclosure, there has to be transparency, there has to be trust. Now, if we're going to treat the customer fairly and offer them advice with absolute integrity that ultimately serves the need of the client and not the insurer and not the advisor, then we have to have independent advisors only in the country. Unfortunately, this is not something that we can fix on this panel. This is something that the regulator needs to look in very closely to. They need to reassess policy that governs our industry. And ultimately, we need to consider whether the advice that's being provided, does it actually treat the customer fairly? Because if the customer is not being treated fairly by tied agents, then it begs the question, should that market actually exist?
Indeed.
Maybe just to add on to that, I mean, when I started in the industry, I started with one of the big insurance companies, and I was there for a period of 6 years, and I'd built up quite an extensive EB client base at that time. And when it got to the point of doing annual reviews, like Lorraine mentioned, I was compelled to use the suite of solutions that they had available for clients, and I felt hemmed in by that. And that was one of the primary motivating factors for leaving to become an independent agent. So, yeah, very much along those lines.
It's a great example. Lorraine, in terms of, Lynn was just referring to EB, in terms of employee benefit advice, what sort of trends have you been seeing in the industry thus far in terms of advice?
There has been a greater move towards digitalization. So a lot of the service providers are now offering digital platforms. And I think that's great because it really gives members easy access to information about their benefits. And it gives you a lot of information. It can give people a breakdown of the transactions that have happened, so it improves transparency. I think one of the issues for me is that it could, down the line, lead towards disintermediation, because then the relationship is built between the member and the product provider or the administrator rather than with the advisor. So I think we need to look into the future and see how we can continue to make ourselves relevant. And also the other issue that digitalization brings in is cybersecurity. And I think that's something that a lot of financial advisors need to be aware of.
Yes.
Because as much as it simplifies transactions, it does add that element of risk, and that those transactions can be intercepted.
Yes.
So financial advisors do need to make sure that they do have the appropriate insurance in place. Even if they do, there's still an element of reputational risk, because if it gets out into the public space that they've been hacked or information is being made available or being obtained by other parties, that can cause reputational risk for them. The other trends that we have seen is a focus on holistic wellness. So there's been a huge increase in people who have mental health difficulties, and this can lead to disability cases, and also it can impact on people's retirement fund savings and so on. So I do think that that is a focus as well. We've seen an increase in critical illness benefits being offered because of lifestyle illnesses.
Yes.
So that is also something that really needs to be addressed.
Anthony, I can see there are a lot of touch points that Lorraine hit that you were frantically nodding your head about. Perhaps you can touch on some of them, especially around how you bridge the gap in terms of this issue or concern around disintermediation. Yes, yes, that concern, how you can possibly bridge that gap. But also as well, just give me a sense of how you've seen the retirement advice environment evolve over the past decade or so.
Thank you, Nampu. And this is a very relevant question for the advisor. And so for the advisors listening in, the fundamental relationship that exists between the advisor, the customer, and the product house, the insurer or the investment house, is governed by trust. And so what we are finding as a trend in our market is what we define as supplier encroachment. If I, as an independent broker, I place my customer, Lorraine, with an insurance house, and what we find is after several months of Lorraine being a client, that insurance house sends one of their tied agents to work with Lorraine on her financial affairs. And that what that does is it breaks the trust between the independent advisor and the product house, but more so undermines the relationship between the advisor and the client. And we don't believe this is good for the market. Incidentally, it's something that we've been very vocal about as ASI. We've written to the Competition Commission on it. We've written to role players like the Financial Intermediary Association to question whether this conduct is permissible, because this undermines the fundamental relationship that exists between a broker or an advisor and their client and the insurance house. And this supply encroachment issue ultimately undermines the social security of advisors. And there's an undertone of fear these days. What we have found is over the last sort of 2 decades, whereas historically 20 years ago, Lorraine, you would have seen this, that 4 out of every 5 advisors were independent advisors. What you find today is that 3 out of every 5 advisors are actually tied agents. And that in a large part has been driven by a psychology of fear. If I don't support this one house, if I don't support this big insurance brand, ultimately my clients will be taken away from me. And I don't think that's a great space for advisors to be in. And ultimately, I think the advice that I'd give to advisors out there is that work with a brand that is governed by the highest levels of integrity and where your partnership is based on trust. And you want to work with brands like Allan Gray, where the fundamental basis of them contracting and partnering is based on trust and partnership. And you'd find this as a golden thread through our business. We only work with insurance houses and investment houses that are based on where the relationship is based on trust, and ultimately the integrity of the relationship and the partnership that we have with our customers are not undermined by that house. Yeah. And so this supply encroachment issue has become a major problem for the industry, but the good news is that the regulators are looking into it. FSCA is looking into it. The Competition Commission is looking into it. And FI, which is the representative body that represents intermediaries in the market, is also looking into it.
Anthony, when it comes to the issue of employee benefits advice, a critical area has been the area of ESG, environmental, social and governance. Just give us your perception around how that has evolved over time.
Nampu, I think what we are dealing with more recently is a more ethically conscious customer base, where they've taken greater interest on how their pension funds are actually being invested. And what we are also finding is, as a result of some part of the generational change of investment into the pension fund industry, that typically issues that would have greater social impact has come to the fore to conversation around investing. And so issues around environment, around social impact, around governance has become a major priority for investors out there. I think what we are finding is that most of the major investment funds and insurance funds are taking a more considerate approach, very much in line with Reg 28, but taking a more considerate approach in how those funds are being invested, and ultimately ensuring that ESG is part of the investment agenda.
So now, Lorraine, there's legislation which has been passed that's ushering in the new two-pot retirement regime. And of course, we know that, there's been a lot of media attention on two-pot. It's been done to death. But funnily enough, ordinary people still don't really understand what it's all about. So from that perspective, how do you think this new environment is now going to impact on the way advice is given going forward?
It's one of those things. It's where things get more complicated before they get simpler. So because members will have three and a half parts, not necessarily the 2 parts, it is difficult for them to understand. And for a while, people will be dealing with 2 different taxation regimes. So there'll be a different tax treatment to their vested part versus their savings part. And that is a lot to take in. So I think there is a lot of confusion. In principle, it seems really simple that you'll have access to part of your benefit while you're still in service, and the rest you'll need to keep until retirement. But the devil is always in the detail, and I think that's where people are struggling, and they don't necessarily understand the major impact that the 2-part system is going to have. I don't think that it's really sunk in that the 1/3 savings part is really supposed to be their lump sum benefit on retirement. And people really need to understand that, because the retirement part will be annuitized. So that will be paid in the form of a monthly income. But life happens, and there's always the odd emergency where you do need access to some form of lump sum to deal with that. And if members access their savings part prior to retirement, they'll have no lump sum to fall back on. So they will have to put in discipline after they retire to actually build up an emergency savings amount. And I think that's going to be incredibly difficult for most people.
Yeah, it is scary if that facility is abused by people. But Lynn, what do you see as the challenges and opportunities of this new regime?
I think our practice is focused on communication and education. So I think initially that's going to be very much around that. And what we've done is to open the services of many of the providers that we work with, because from an administration perspective, what we have found helpful, and this is where it makes sense for the big providers to step in, is that they've set up systems where employers and brokers don't need to get involved in the claims processes. So I think initially, from an advice perspective, whether we advise members to make withdrawal claims or not, many people are standing by waiting to make that first withdrawal. So whether you advise them to do it or not to do it, it's irrelevant at the moment. So perhaps in time, through that education process, we'll be able to guide them on the importance of retirement savings. The intention of those monies was always for retirement, and not to look at it as anything other than an emergency pot.
So Anthony, at this time, with the 2-part retirement fund system now kicking in, how do you think advisors can best support pension fund members in the event of, resignation, retirement even? How can they be supported at this time? Because those are massive changes in their lives and it has implications.
Nampa, this is a relevant question. We should maybe also ask the question, why is the 2-part system in place? And the 2-part system has come into effect because we have a society in South Africa that places a low degree of importance on preservation and savings. We've got a bad savings culture in our country. And of course, COVID exacerbated some part of that, with people resigning from the employment just to cash out because they were in a cash crunch. So how do advisors support this behavior? I think the starting point is we got to educate the South African community, especially pension fund members, on the importance of preserving. We've got to spend more time getting them to appreciate the importance of legacy planning. And especially in our black and brown communities, we are particularly bad at building legacy planning. And so I think there's a real great need for advisors to go out and actually spend time educating the clients. I mean, the PF 130 guideline, which is incidentally part of the Pension Fund Act, it's a regulatory guideline. And what the PF 130 guideline talks to very specifically, aside from conflicts of interest being disclosed, where an advisor or a product house needs to disclose inherent conflicts, there's also a requirement in that in that guideline to educate the member of a fund. And so I think the big focus of advisors has to be education, has to be legacy planning, and stressing the importance to clients that cashing in is not necessarily the answer. And often it's the short-term gain that results in the long-term pain.
No,
and that's what we've got to teach our clients. So it's really comes down to financial literacy.
Yeah.
One of the opportunities is that people are going to be paying a lot more attention to their retirement fund savings now, because they will be checking the balance in their savings pot on an ongoing basis. So I think it will take front of mind for them. And that's a good thing, because it will incentivize them to understand more about their retirement fund. My concern again is the potential of disintermediation, because the savings pot withdrawal benefits, those claims will be submitted directly to the service providers without the intervention of either the employer or the financial advisor. So the financial advisor won't necessarily know that they should contact the member to give them advice on whether there's perhaps any alternative options that they have if there is a financial emergency
and
that they're going through.
And hence there's been a strong encouragement that should people want to withdraw, they should first consult with their financial advisor.
Absolutely.
But
Yes.
if they don't need to, they're not going to.
Absolutely.
Lynn, let's still stick around the issue of financial literacy and education. In South Africa, of course, our financial services sector, as well as the regulators, have really gone out of their way to ensure that people do get that financial literacy. But it seems South Africans still struggle with that, making wrong decisions, getting loans from the wrong places, etc., etc. So what more do you think can be done? We know that obviously economics is a factor. Some people don't actually have enough to be able to save, let alone invest for the long term. But what more can be done from the retirement fund advice space to conscientize people that much more?
I can only speak from my experience, and what we've done is to set up a series of presentations, and we will focus very much on that component of it. One of the discussions we had with one of the providers was around how that pot should be invested differently to the rest of members' retirement savings. And our philosophy is that it shouldn't be invested differently, because then it's going to be viewed differently, and then it'll be viewed as something that could be accessed on a regular basis. So our narrative is going to be very much around viewing it as a long-term savings plan and using it as an emergency fund only if it's necessary. But through those presentations, we'll kind of reinforce that philosophy, and it'll allow members to ask questions. And that's always a good thing for us when there is engagement, to focus on those key issues.
Yeah.
I do think that there is opportunity for the retirement pot to be invested even more aggressively than it has up until now, because it will have a far longer time horizon. And I think that is something that the legislature should give consideration to. I always find it bizarre how, while members are employed, prior to reaching retirement, they're constrained by Regulation 28, which limits how much you can invest in equities and so on. But once they retire, they can invest in a living annuity, and they can invest wherever they want.
Yeah.
And that's always struck me as something that doesn't really make sense.
Nampi, if I could just add to that, I think part of this financial literacy theme that advisors need to focus on, it's not just about their retirement benefits. I think advisors need to focus on holistic financial planning, and that goes to budget in the household. And those fundamentals of debt rehabilitation, because we have a highly indebted society in South Africa, which is the reason why they want to cash out from their pension funds. The second part is teaching them the importance of saving. This simple principle around having high interest-bearing debt to low interest-bearing debt. If you've got a short-term loan, rather settle that loan at a 27% interest or first, and then start redirecting your money into lower interest-bearing debt. And so there's an importance around helping the client around their household budgeting and savings-based culture. And I think if you could put it into 3 tiers, one is the principle of debt rehabilitation, getting the customer or the client out of debt. As a second part, building a savings-based culture in the household and getting them to budget effectively, something that most South Africans do particularly badly. And then as a third part is helping them preserve and invest long-term. You can't have a discussion with a client around long-term investing if the foundation of what you're working with is broken, and that is they don't have a budget, they are highly indebted. It's not going to work. And I think that's where most advisors get it wrong. And I find this typically in the tied agency market, that the tied agent would present a product brochure and the costing of those products or quote without actually understanding the underlying issues that affects that family. What are you paying towards school fees? What are you paying to the household rent? What is the monthly food budget? What is the client actually earning, and what does the household budget dictate? So we can talk to them about preserving at 15 to 27% of their gross earnings, and yes, there may be a tax deduction. But if the individual is earning 20,000 Rand a month and has got 23,000 Rand worth of debt at the end of the month, you've got to start addressing the underlying cause of those problems. And so what we've seen as a great need in our client base is to actually put them through financial coaching and counseling, rehabilitating them from debt before we can talk about preservation.
Indeed. That makes a lot of sense, the holistic approach.
The other important aspect that I think needs to be addressed is education for women, because the dynamics around women's saving for retirement is very different to that of men. There have been some articles in the press recently about concerns that the two-part system may have a more negative effect on women rather than men, because women are more likely to take on the caregiving role. And also there are a lot of single mothers out there. And the opinion is that they may be more likely to withdraw more money from their savings pot to perhaps pay for children's school fees or to care for an elderly parent, and that will leave them far worse off in retirement. And I do think that communication education does need to deal with topics like that.
Yes. So from that perspective, Lynn, I mean, of course, you've said that you have a way that you're going to be communicating to your clients, in light of the new dispensation. But do you think at a broader level, maybe at a regulator level, at a higher societal level, there needs to be drives like this, communicating directly to women, for example?
I don't think the communication needs to be with women in isolation. I understand women are more vulnerable, but in the industry, our experience has been very much that the providers, the press, advisory practices have been really on top of communicating what the changes will look like, how it will impact our members, how their benefits will be structured going forward, and what the claims processes are.
So moving on now, Anthony, I wanted to ask you, what are the biggest risks that you foresee in the advice space? I mean, we've talked a lot about the distinction between tied and independent and, regulation, et cetera, but what do you see as the biggest risks?
I think the number one risk is the social security to advisors, and the fact that there's been regulatory push around advisors moving directly on a fee-for-service model, where clients are billed for their services rather than them earning an indirect fee. The way the market operates for the most part now is that you would place a client with a product house or an insurer, and ultimately you would earn a commission or fee back from that insurer. Yes, the advisor should be disclosing that fee, but ultimately what the regulator would like to see is greater transparency and accountability in that relationship between client and advisor. So I see that being one major risk, and I see it as an opportunity and a risk. It's a great opportunity for advisors to build a better relationship with their clients, but it is a risk because most advisors are not ready for it. They don't have the systems, they don't have a value proposition that's ready for it. And so I would encourage advisors to look at that. And one of the things that we are doing in our space is actually educating brokers and advisors on how they could better serve their clients with a value proposition where the client feels comfortable paying that particular fee. I think I see a second major risk is really AI and digitization of advice, and where customers are really going directly to the product house. And there's some generational influences. If you look at millennials and your Gen Zs, my 10-year-old, instead of actually talking to his dad about information, goes to YouTube and Google, right? And that's because you have information real time. And AI has become so sophisticated that a lot of information about a market could be derived through AI. I think I'm fairly pleased with the fact that AI can't give you financial advice just yet. I actually tested that this morning. So it can't tell you which is the best product to buy with an Allan Gray based on your financial needs. But that is going to become a risk as sort of computer intelligence and AI becomes smarter than it currently is. I think it's just a matter of time before it's able to help customers eliminate products that are not suitable to them, and ultimately reducing the need for the advisors. So the first risk I see is, of course, fee-based structures changing. As a second, technology. And I think as a third, there's been massive consolidation in our market where insurers and investment houses are developing their own tied agency forces, and offering these, what I can only describe as perverse incentives, these 30-40% commission overriders so that advisors can lure clients to them. And what I've seen over the last, sort of 2 decades is that most of our independent advisors have almost been forced, as a fear of loss, been forced into these tied agency models. So I see that as the 3 sort of big trends impacting the advisory industry in particular. As a fourth, the increased need for governance compliance, because we work in a highly regulated environment. And probably, Lorraine, you'd agree with me, we're probably closely aligned to what's happening in the UK.
Yes.
And, if you study what's happened in the UK markets versus what's happening in the South African market, the only way that an advisor, a business like Silvertree, which is where Lynn's from, is you've got to have systems and processes to govern that. And technology requires investment. The challenge that a lot of smaller FSPs have is that they simply don't have the capital to invest in those systems. They don't have, the resources that larger insurers would have in investing into their own systems and processes. And so I think it gives a great opportunity, as much as it's a risk, for smaller brokerages in the market to partner with other businesses. As much as you would be partnering with an Allan Gray as a product house, you could partner with other brokers. And I want to encourage all advisors out there. There are great brokerages and financial advisors and brokerages that operate with the highest standards of integrity. Find brokerages and partners out there that have a very similar culture and value system to you, where you mirror in DNA, and work with them to serve your mutual clients, rather than losing those clients, to the tied agency market. Find a way of working well with each other. I think what the insurance market has done particularly well, some of the major product houses have done particularly well, is they've sowed a seed of mistrust and distrust amongst brokers. Traditionally, Lorraine and I would not be sitting alongside each other talking of, to the value we can add to customers, because it was really about pegging brokerages against each other so that one product house could win over the other. And that isn't healthy for our market, right? I really believe that people like Lorraine, Lynn, and I can work really well with each other. And we can serve our mutual clients really well.
Yeah.
And we can do that with product houses that ultimately believe in the power of independence and believe in this trust capital and currency that we trade by, and ultimately serve the most important stakeholder in our market, which is the member of a pension fund or the client of a pension fund.
So, Lorraine, it does seem from what Anthony was saying just now is that, he's pushing sort of maybe for a consolidation within the industry, given all the challenges. Would you agree with that? And what do you perceive as some of the risks in the retirement advice space?
There has been consolidation, and I agree that it's very much driven by compliance. We have a lot of compliance requirements that we need to adhere to, and it is in the best interest of members. All of these compliance requirements were put in place to protect members, but it can have the opposite effect for some groups, because for smaller groups of employees, the revenue that a financial advisor will receive from them isn't necessarily enough to cover the cost of compliance, as well as allowing for the delivery of excellent advice. And we've seen product providers as well increasing their minimum business requirements in terms of the number of members that they'll accept. And so from this point of view, I think that micro companies may well be given a disservice by the levels of compliance that are in place. And the other thing that I think drives the consolidation is the complexity of products. ideally to leverage off that trust relationship that Anthony mentioned earlier. Products need to be as simple as possible because it makes it a lot easier for members to understand them then. Whereas when products are so complex that members don't necessarily understand them, or that they miss out on some of the nuances, and as a result that they're not necessarily entitled to a benefit, that can create a lot of distrust in both the product provider and the financial services industry as a whole. And I think because of that, and because of the cost of these overheads, it has driven consolidation.
So, Lynn, a thread that's been sort of threading through our conversation has been around the issue of transparency and integrity. How well do you think the retirement advice space has done in this regard? Do you think that there's more work that could be done?
I definitely think there's more work that could be done. I think the industry has traditionally been quite opaque. And I started in the employee benefit sector in 2001, and initially stepping into the independent space, doing comparative quotes with different providers, for example, to try and compare one to the other was extraordinarily difficult. We do have the RSC now, which is a standard in the industry where one can compare proposals more carefully. But I think there's a lot of work to be done around that. I think the plain language needs to be a focus for members. So imparting what their benefits are, what they mean, needs to be changed to make the language more accessible. But those are, for us, those are two key areas of focus. I think there is definitely work to be done on that.
And then, Anthony, onto the hot topic of transformation. We know that the financial services sector has evolved quite a bit. It was sort of traditionally a very white male-dominated industry, and now we're seeing a lot of colour that's come into play. You've got CEOs like Mary Vilakazi of First Rand, which is quite a coup for an individual such as herself. We're seeing progress, but from your point of view in the retirement advice space, how well have we done over the past 30 years?
Nampu, this is a great question. I think the framing around white monopoly capital, which is often bandied around politically, comes from somewhere. The reality is that the industry has done really, really badly. We have made modest progress at best over the last 30 years. If you look at the financial services industry, over 85% of businesses in the financial services industry are traditionally white-owned, right? If you look at businesses on the JSE, it's really the levels of black ownership and participation has been very modest. More recently, the Financial Sector Conduct Authority and the Department of Trade and Industry through the BE Commissioner's Office has joined hands to drive transformation more actively in the advisory sector. I think with that particular partnership, we would see a lot more traction and development and advisory businesses becoming more empowered. There is a need for advisory businesses to become empowered. We've taken a very bold view as a business that we want to drive transformation through ownership and not employment equity. Mary's appointment in First Rand is a major win for us in the employment equity space, and I speak on behalf of black business when I say this. It's a major win for us. We want to see more black executives and professionals enter the space. But you can't transform businesses just through employment equity. Businesses need to transform through ownership. And what we do know is where there are majority levels of black ownership, the transition in employment equity is accelerated. And that's because there's a particular agenda that drives that. And so as much as we have not made a lot of progress over the last 2 to 3 decades, I'm pretty optimistic about the regulators' recent efforts of taking a more active interest in the market. We've seen a lot of insurers set up their own tied agencies, black-owned tied agencies. I don't believe they would perform and do as well as the independent market. I really see the independent market sort of flourishing with some of the recent trends. And I would like to encourage all advisors out there is not to fear BE. Black economic empowerment at its core has a great spirit and intention behind it. It's really about transforming the sector and ultimately expanding our market. In order for us to get to the gogo in the township that buys 5 funeral policies for the price of a life cover that she could potentially get at 50% of the premium, in order for us to get to her as a client, the industry has to transform. The face of the advisor has to transform. 25 to 30 years ago, the average advisor was a 55-year-old white male. We need to see more female advisors in our market. We need to, because what we do know, Nompu, is that sometimes it's not dad in the home that takes care of the financial affairs. It's mom in the home that takes care of financial affairs. Being raised by a single mother, I can appreciate this better than most. And so we need to see the face of advice change. We need to see the ownership of the advisory space change. But more importantly, we need to see our markets change and our target audience change. The challenge that you have in South Africa is that the active participation of previously disadvantaged groups, we still have poverty in the country. And the face of poverty in the country is a very clear demographic and race. We must accept that. In order for that to change, we've got to change ownership levels. We've got to change the demographic of our advisors in the country, and that requires people like Lorraine, myself, Lynn, to train them, to recruit them, develop them, train them.
Well, that's what I was
so
going
we
to
can
ask
have
you.
an impact.
Well, that's what I was going to ask you. Has there been a reluctance within the industry to do that, or is that an improved picture? Because you talk about ownership, but I can't just get up and own an advisory firm. I need the critical skills, and you need to get those critical skills from mentorship and maybe an organization. People need to come up through the ranks and then be able to do that.
Absolutely.
So are you seeing a positive trend in that regard of organizations, traditional retirement advice houses actually training people up to put them in a position where if they wanted to, they could actually set up their own thing?
Nampu, we're seeing a lot of activity in the large corporate space. So typically large corporate businesses that can afford to do that. They can do enterprise development, supplier development. We're not finding the same in smaller businesses. We have roughly about 12,000 FSPs in the country. And these, in advisory houses or brokerages, if you will, at an average size of about 5 people, right? And so a small brokerage does not have the allowance, the time, energy, nor the financial resources to drive, skills development and transformation at the level that the industry needs. But we are seeing a lot of active work being done by larger businesses. ASI in particular has done particularly good work in finding smaller brokerages, SMEs, empowering those businesses, giving them access to capital, bringing young black trainees in so that we can develop them into future professionals and business owners. It's been a very strong focus of ours. However, has to be more work done in that space. I think what needs to happen is between the regulators, and I say the regulators, FSCA, the Department of Trade and Industry through the BE Commissioner's Office, and SARS, South African Revenue Services, and these are all the institutions of excellence, has to think about an incentive model for advisors like Lynn and Lorraine, for advisors like myself to take on these young black professionals. And there are skills development incentives, but there's a minuscule value offered to an FSP. In fact, for the most part, 80 to 90% of the bill is really carried by the FSP. Skills development stipends don't necessarily cover that. So I think the regulators need to put their minds together and create a more favorable incentive structure for FSPs like ourselves to take on learners at a larger scale. I don't think, and I speak for all advisors in the market, and let me say it more plainly, I speak for the white financial advisors in the market. I'm yet to meet a white financial advisor that says, I don't want to train and develop other people. There's absolutely a willingness. We work in a remarkable sector and an amazing industry. Financial advisors want to impart their skills and knowledge, but they want to do so responsibly. They want to do it over a period of time. And ultimately, they want to see value. If I've built a business, a brokerage over the last 15 to 20 years, I'm not simply going to give it away. And I want to say to advisors out there, BE is not about taking your business and giving it away. We've done at least 30 of these transactions in my career. And money exchanges hands. There's value. And so there's a way in which you can find a lucrative and an effective BE partner with a lucrative deal attached to it, have a favorable sum of money paid over to you in capital for the hard work and investment that you put into the business, and do an effective deal. It's like any other business transaction.
Lorraine, let me come to you. Female representation in the retirement advice space. It's great to have you and Lynn on the panel, but how are you guys actually represented out there in the market?
The financial services industry has done an excellent job of allowing women to rise through the ranks. And I don't think that there is an issue with representation amongst women. But I also look at diversity from a different perspective. So yes, it's important from a transformation perspective to actually change the face of the people at the top of organizations. But one of the phrases that our organization uses a lot is the power of perspective. Really good advice is given by knowing your clients and understanding their needs. And it's very important to have diversity in the advice space so that you can properly understand your clients' needs and give them the most appropriate advice that there is.
Absolutely.
Nampa, I just want to add one point, and that is, I'm a big brand advocate for Brand South Africa. And part of building Brand South Africa requires us to build local businesses. And more so build businesses that have generational legacy attached to them. As South Africans, it's not something that we do particularly well. We've got some great success stories in our market. And ShopRite Checkers is a great example of being one of the largest employers on the continent. We need more businesses like that. It's not just about global brands investing in our country, because as we've seen over the last 20 years, globalization has hurt our economy at levels and at a magnitude that we could never fathom. The stimulus for the country, the future growth and success of the country, comes from local businesses. Advisory businesses, for the most part in South Africa, at least 95% of them are local businesses. The question is, how do we get those businesses to sustain themselves, create legacy businesses out of them, and ultimately get these businesses to hand over to a young generation of entrepreneurs? That's got to be the focus for us. And I'm incredibly encouraged by what Allan Gray is doing in the enterprise development space and the SME development space, in investing in smaller businesses, local businesses. We need to see more of that. And perhaps the solution for South Africa first lies in us investing in local businesses. Perhaps the solution for the financial services sector resides in the power of legacy partnerships. Perhaps the solution for clients lies in us partnering together to serve their needs of legacy in the country. Because if we're going to eradicate poverty in the country, this 54% of social grants that are predominantly women and children, if you want to address that Gini coefficient, then we've got to come together as business and I think the financial advisory sector to target that very common interest that we have.
Lynn, in conclusion, we've covered quite a lot of ground, but what are your feelings about the space that you work in? Are you optimistic about the future? Do you think that you're needed more than you've ever been needed before?
I think the changes that have been made have been positive over time. As I mentioned earlier, I think there's more that can be done. But I think the level of member engagement, employer engagement has changed over time. Employers have a greater understanding of all the additional holistic needs of members, and the space has changed to accommodate that. So wellness programs, financial wellness programs, more member integration on multiple levels. The providers have made it easy for blue-collar workers, for example, to engage with their benefits. Those are all very positive trends in the industry. We're very positive about it.
Yeah. Lorraine, is the market oversaturated with you lot, or do you need more people in there to come in, including women and black people, to give advice to South Africans? How do you see the space right now?
There's definitely space to include newcomers, especially younger generations, because that is something that we are facing now in terms of the different generations' view towards work, towards financial savings. And we need young people to come into the industry to allow us that perspective. So I do think that is really important. I wouldn't want to be oversaturated myself. I think that the world would be better with two of me, but that's just my personal perspective.
Indeed.
But yes, I really do think that there is scope. One of the things that I love about this industry and has kept me in it for so many years is that there's always change. I'm someone who gets bored very easily, and the fact that there's always new legislation to deal with and new products out there to learn is something that always keeps me interested and keeps me loving the industry that I'm in.
Yes.
So I would definitely recommend it to anyone looking at creating a career for themselves.
And Anthony, just to end with you, it seems as though, even though when you speak to private sector players, they always complain that, there's too much regulation, there's too much legislation, and when you're over-regulated, it stifles your ability to operate. But you seem to be quite welcoming of more regulation, to get the industry on the right footing. Your concluding marks around some of the discussions that we've had?
The private sector, for the most part, often points its finger at government when it comes to levels of corruption, governance and ethics. One of the trends, we are finding in market is that there's almost an ethical consciousness from clients around how their monies get invested. These monies must be invested into businesses that are environmentally conscious, socially conscious. It must be in investment schemes that operate at, with the highest standards of governance and compliance. And in order for us to avoid some of the bad investments that have taken place, the Steinhoff saga, which is quite widely publicized, pension fund members lost monies. This is a listed company and arguably with the best levels of governance at the time. In fact, we looked at some of the audit reports that had come back from this business. We can't hold the private sector and government to a double standard. In order for us to protect the end user, being the pension fund member, the client that ultimately participates in the financial sector, there has to be regulation. I think we have an amazing regulator in FSCA. They've done some amazing work over the last decade and a half. And I hope that they continue the good work that they're doing. But what we have to do is we have to drive regulation to get some part of those FSPs that are not necessarily treating their customers fairly. We've got to understand what is the spirit and intention behind regulation in our market. It is to protect those unsuspecting clients that don't necessarily have the knowledge and experience that Lynn, Lorraine and I have around the markets. Clients that would trust you as an advisor to do the right thing and operate with integrity. And the regrettable part, Nompu, is that not every FSP out there operates with the standards of integrity that we do. And so I'm embracing of regulatory change. I support most parts of the regulation. I think we've got to be careful that we don't stifle the ability of our market to grow and don't bring in very complex change, but certainly change that protects the end user, being the customer, we must absolutely support. Because the purpose that our industry has, the purpose that every product house has, is to serve. We're here to serve the South African community. And we've got to remind ourselves of that. In order for us to serve, we've got to serve with integrity. We have to build trust capital between ourselves and the average South African. Now, we can say that government doesn't do that well. I don't think that the private sector always does that well. But perhaps it's time we start changing that. Perhaps this is the new chapter that we write as partners holding each other's hands in both business, private sector and government, where we say we're here to invest into the trust of our people. We're going to operate with integrity. And if one way of doing that is introducing regulatory change, then let's embrace the change.
Well, on that contemplative note, thank you very much for your inputs there, Lynn, Anthony, and Lorraine. Thank you so much for that abundance of wisdom. And we do hope, of course, that this has been of value to you. I've been in conversation with Anthony Govendor of ASI, Lorraine Dias of Mercer Marsh Benefits, and Lynn Kimball of the Silver Tree Group.